Thank you for joining me. I want to talk about what is short selling. And make sure to subscribe if you want to learn more about investing in personal finance. I'm making videos every day before market open. So basically, short selling is selling a stock that you do not own. Which means that, say you want to short Tesla. You need to have a margin account with at least $2,000 in cash. And in that margin account, you can basically sell Tesla stock without ever buying Tesla stock. So in detail, that means your broker needs to have shares that he can lend you that you can then sell and buy back later. A lot of stocks don't have a whole lot of shares available for borrowing, especially with your broker. So this only works with bigger stocks or stocks that your broker is trading a lot, or your broker has a lot of clients that actually own the stock, preferably not selling at any point. So then obviously you buy back the shares at a later date to close the position. Which means when you sell the stock, you open the position with a negative amount of shares. Just like if you bought a stock, you open a position with a positive amount of shares. So if you were to buy 100 shares of Tesla, you would buy to open a position, and you would then own 100 shares of Tesla. If you wanted to short the stock, you would sell the stock to open the position, and then you would have an open position with negative 100 shares of Tesla. And in detail, if you do have a margin account and you do have $2,000 in cash, many brokers allow you to search for a symbol and then sell the shares right there. So you have a stock quote, you have a price, and you then sell those shares even though you never owned them. And then you have a negative amount of shares until you finally do buy and close the position. And the risk at this point is that you have a margin account and you have a negative amount of shares. And if you do not have enough money to cover the eventual covering of that short position, you might get what is called a margin call, which means you don't have enough money to buy the shares if they were to go any higher than they currently are. So your broker automatically sells your shares or automatically buys shares for you to reduce the risk that you have. So let's say you shorted 100 shares of Tesla stock, which is about $25,000, and you don't have, so when you sell those shares, you get the $25,000. Let's say the share price is at $250. So you have the $25,000 sitting in your account. You also have $2,000 sitting in your account that you had to have to be able to short sell. If the share price now goes from $250 to $252, you don't have enough money to buy back the shares to close the position, which means your broker automatically buys a few shares to then reduce your risk. So if the shares were ever going to go up by $50, you would have to have another $5,000 in your account to be able to not automatically buy the shares to close the position or to reduce your position. So that's all there is to know about short selling. Hit the like button if you like the video, and make sure to subscribe if you want more videos like this. I'm doing more videos every day before market open. I hope you have a successful day.